welcome everyone to this week's bi-weekly update here at Gentian. And today we're going to have quite a few great updates from both Ken's Corner, from Zach's Facts, from Mike's Minute, and we'll have Ryan today with what's happening at Gentian. So I wanted to kick off today with some of the different ideas. It's summer, so many of you have had a vacation, you're traveling, you're creating great family memories. The weather here has been reasonable, which has been interesting. Near the lake, we're in the 70s. I talked to my mom in Iowa, and it's 94 and crazy hot. So we're getting summer storms, eating watermelons, seeing fireworks probably over the 4th of July, maybe more on the 3rd with the weather that we had as well. But a lot of people really have been having a lot of the conversations with family around summer and being the best 10 or 12 weeks, if you will, in Wisconsin. So I know a lot of you probably don't travel because you want to stay here, but I've heard a lot of people having people in and going to different events. This weekend is Gathering on the Green coming up here this Thursday, Friday, Saturday, Sunday. So we'll be quite busy hosting some of those events as well. But a lot of what we're looking at today is starting with our summer go big. So my go big is spending time with family on the 4th of July, spending some time on a lake, watching fireworks on Big Cedar. But more importantly, even just with the team, spending a little bit of time as we can. Last Thursday, we spent an afternoon at Summerfest together, which was nice for those of us who could. And there's quite a bit more. I got probably 20 or 30 things I can be grateful for, but I'll start with those. Let me pass it over to Ken, though.
Good morning, everybody. Good to be here with you all. I am grateful for family, of course. But as we get our June statements and things of that nature, I'm actually grateful for all of you because a lot of you taking a deep breath through all this. A lot of you, when we talk to you, yes, we know to stay the course and invest any extra money we do have. Hearing a lot of that. Why am I grateful for that? Is because, when you do this long, when you do something long enough, and we've been doing this for a while now, we've seen the mistakes that sometimes people make, and sometimes the mistakes are permanent. Wealth disappears and goes away, never comes back if we make mistakes during this time frame. Families had to change lifestyles because of decisions as well. So I'm grateful for all of you that really take the time and really put the, just really take a deep breath right now and understand this isn't the fun part of investing right now. But I'm grateful for all of you that are staying the course because we know that to be the answer right now. So thank you for all that you guys do, and thanks for your trust and confidence.
Thank you, Ken. How about Zach?
Thank you, Chris. As always, like yourself, many, many things to be grateful for. Specifically over the weekend, plenty of time for reflection. And I'm just unbelievably blessed to be part of the Gentian team, the Gentian family, both with the team that you see here, the ones you don't see, and also from yourselves and all the wisdom that you share. It's extremely humbling, and my life is on a completely different path because of each of you. And it's just truly amazing to come here every single day. And I too am extremely excited for Gathering on the Green this weekend. It's an amazing event that our team has worked really hard on for the last year, especially the last couple of weeks. And it's just a great time spent with each of you. So I can't wait for the next 4 days.
Outstanding. Thank you, Zach. How about Mike?
Thanks, Chris. I'm gonna switch gears a little bit. I'm grateful for my girlfriend. She made the drive back from Washington, D.C. to come and spend the holiday weekend with me. So that's 13 hours one way. And at this point, it's about $450 in gas. So, so much gratitude goes out to her.
That's awesome. Thank you. I appreciate that, Michael, as well. And then we'll bring Ryan on as we get on. Actually, Ryan, you're on there now. Why don't you give us maybe your gratitude for the week?
Yeah, absolutely. I'm very grateful right now for my family as we're getting a little older. My daughter Sydney is turning 5 years old this weekend. So July 9th will be a big day for her, and she starts kindergarten this fall, and she's getting into gymnastics classes and soccer teams now. So I'm really grateful that she's, getting a little bit to that age where I can start to do some of the things I've been excited to be a dad about.
Thank you very much. That's awesome. So there's a few things I want to reiterate, maybe in perspective, and a few things I think that we can kind of star on today. First of all, we look at the idea that everybody's been talking about recession for a long time. Remember, the market really mostly hates things that come out of left field, things that people don't know. People do know rising gas prices. They do know war in Russia and Ukraine. You can kind of go through the whole litany and list. Inflation. We've also got, oil prices, which are very high. As Mike just mentioned, gasoline prices are off the charts, causing much of the inflation we've talked about in our gas prices, also in airline prices. So a lot of those things have been reflected. And especially also in food prices, I've noticed lately. So as you go through that, that's a lot going on this summer. It's kind of a wonderful time weather-wise here for us in the north. For you in the south, maybe it's a little bit warmer and maybe you stay inside during this time. But it's, again, a time for us to get out here in the north and enjoy this beautiful weather. But I know as things are going outside, it's weathering the storms that come about. If you look at this beautiful day yesterday, the day before, there were incredible storms last night. If you looked across the sky, as we were driving home from getting some food at about 7:30 or 8 o'clock, we looked down Highland Road and there was lightning that just literally lit up in every single direction. And, those are the storms that also hit in the market. You're hitting this beautiful, beautiful day, and all of a sudden something kind of creeps up. This storm, when it comes to a correction like we're having now, tends to be longer. It tends to be something that started last year, probably if you can look at maybe technology stocks, even over a year ago. Small cap growth stocks, very similar as well. I know Zach will talk more about those in a bit. But if you're looking at some of these, it's one of the worst starts for our market since 1927. So there were only three: the Great Depression, 1 year of World War II, and then the Vietnam War and the tightening cycle back then. So we do a ton of research on these for perspective. But looking at those, it's really interesting to watch and see where we are in the overall big perspective. That being said, though, too, according to research as well, I think by Global Small Caps, and this is by JP Morgan in May of last month, global small caps are, and US small caps are at a relative low since 1970s. I mean, very, very low. Over the last 20 years, as low as they've actually been for small cap growth stocks, especially when it comes to the growth stocks that are the ones that will be potentially the next Amazons, the next big names you'll know about. So they've been really, really hammered, but that happens in the growth cycle. That's why growth is much more volatile. We're actually experiencing it now. These are the things we look at and we study. There's a lot more statistics I could probably bore you with quite a bit, but we go through these to pull out little facts I think that are super important to you. We get it. If you're going to look at your statement, some of you say, hey, I'm not going to look at my statement during corrections. Well, that's really up to you, quite obviously. Some of you follow it every few days on the online system. What's interesting too is some of you check it once a year, once every few years. We've recently had some meetings with clients, and it's interesting. We had a client who started with us just in January, and during the meeting, he goes, "Man, I feel sorry for you guys. We happen to invest money right at the wrong time, and I think I hope those guys don't feel bad." So actually, we of course, said, "Oh, it was bad luck," and we were very, concerned for the client, bad luck, the timing. But he actually was more concerned for us and how we felt, because he goes, "I know corrections are just inevitable. They're an inevitable part of investing. We happen to jump right into one." So it's really interesting to hear clients actually being concerned for us. So thank you for that as well. So the perspective is really both and always. We really do appreciate that as well. What I start to notice when summer really gets into bloom, it starts to happen right about now as I run the Concordia Hill. It's usually just a whole bunch of weeds, it looks like. I mean, it looks kind of overgrown and quite ugly. The Concordia Hill, you can walk it, but you can run it. But about this time of year, a massive change occurs, kind of unexpectedly. Now, I expect it because I've been there, but the unexpected is all of a sudden the entire hill blooms. One of the hills on Highland Road over here is blooming with phlox, red, pink, and white, and it just all of a sudden turns from weeds into some beautiful things as well. That's often how markets recover as well. You won't be expecting it, and all of a sudden out of the blue, you'll start to see some flowers. Oil prices will drop. People won't travel as much. They'll change their behavior for all these inflation cycles as well. So what you see occurring here, I want to just offer perspective on. It's not the first time it's happened. It's not the last time it will happen. But what's really interesting about this one is the pervasive negativity that people are feeling as far as their confidence. So they're feeling very, very, very weak confidence right now. So I guess it's called a lack of confidence, if you will. And that's what's more surprising about this one as well, is how people are feeling. Now, what I'll do here is I've got a few more things I'll talk about as well, but I just wanted to offer you that perspective. There's a lot of incredible, interesting facts. I've got like 72 exhibits I have from different sources, from JP Morgan, Credit Suisse, and others. But most of them are telling the same story. Some of the biggest growers that are out there, the really big growers, that's these small companies, and the companies that are growing the most, are the ones that have been hit by far the most. The companies that in the pandemic were up 100% are actually now below pre-pandemic levels. Now, their growth hasn't stopped. So you tell me what that equation might lead to. Their growth has continued. They are now lower than they were pre-pandemic. Quite interesting, eh? So these are some of the different issues that are going on as well. But with that, why don't I turn over to Zach's Facts. Zach, is there anything that we should know about what's going on in the market and some of the different ideas?
Yeah, absolutely. Thank you, Chris. And you alluded to one of the great sources that we went through to prepare for today, which was the JP Morgan Guide to the Market. So I'm gonna go through all 72 slides real quickly here in the next 20 minutes, and we'll be good to go. But no, we'll just summarize a few of those extremely important ones. But just going through year-to-date returns of the different indexes, the S&P 500 temporarily down 19.61. Pretty good recovery over the last couple days as well. Dow Jones 14.78 temporary correction. The NASDAQ 27.63. And if you remember from our previous ones, the NASDAQ is 50% technology. So that's where a lot of the temporary correction is occurring. The Russell 2000 22.45, which is small caps. The growth portion of small caps 28.16. Value 16.7. International 21.04, and emerging markets 20.18. One of the amazing things with emerging markets that we saw in the JP Morgan Guide to the Markets report that Chris mentioned before is the unbelievable amount of people across the world moving to the middle class, especially in the Asia Pacific and especially in India. So a lot of potential huge growth ahead in the emerging markets. One question we get is just, what are some of the things you guys are going through? We're going through all the financial planning items that we can control, that Ken alludes on every time. And also Mike and Ryan are doing a ton of work right now, going through different portfolio strategies, also meeting with representatives for each of the funds that we use and making sure that they're doing exactly what they're supposed to be doing relative to their peers, or different ideas and strategies that we should be looking at. One thing from the JP Morgan Guide to the Markets that we wanted to take a look at, just to add a little perspective, is what is the average duration of a bull market, essentially the upward market. The average duration of a bull market since 1929 is 51 months and 162% return. The average bear market is 20 months and a temporary correction of 41% during that time. So going through that with perspective, that's one of the many reasons why we absolutely love bear markets, because of the planning opportunities that Ken and Chris, myself, continue to allude to or call you for, but also what is historically on the other side of a bear market. So just real quickly, we'll touch on fixed income, and we'll pass it back to Chris and Ken and Mike. The 1-year current yield to maturity is 2.03, the 5-year 2.95, the 10-year 2.91, the 30-year 2.94. One reason we really look at duration when it comes to the bonds inside of our different strategies, the current index for the 10-year is down 11.35 for the year on the 10-year, and the 30-year is down 20.13. So that's on our fixed income in the bond portion, the side that's supposed to give us the temporary protection from these corrections. So that's why we're really careful with duration. And just one thing that we're seeing as well is that we're seeing a lot of products starting to come out to lock in a certain rate, especially indexed annuities. So they're saying that, there's no downside to these. You're getting a cap at 5%, but we have a temporary correction of 20. We've went through the temporary pain, and now they're trying to cap you at 5 or 7% on the growth side. So just be leery and weary of different products that come out during these times that kind of prey on fear. With that, I'll pass it back to Chris.
Absolutely. Thank you, Zach. Yeah, I've seen that for many, many years. You'll find products that come out that seem too good to be true. You'll find, though, a lot of times, like now when interest rates are rising, you have lump sum pensions, and lump sum pensions now are actually quite, for those who are eligible and may take them or retire, are actually quite appealing, especially if the rate was set last October or December, as rates have come up substantially this year. So there's two different, remember, interest rates have two different, let's call it fans. One is people who are savers love it when rates are higher, right? People who are borrowers love it when rates are lower. So it's interesting to look at this kind of tale of two cities, and sometimes there's a fine line in between the two. Where does it actually reach, if you will? What's interesting, we do a lot of reading, a lot of different books, a lot of perspective ideas. We don't bring them all to you because it'd be overwhelming. But what's interesting is, I think this reading has also, my daughter reads a ton as well, all sorts of crazy books. She's picked about 20 classics this summer she wants to read. And then some of the stuff I'm reading as well, which is pretty funny, because the other day, she turned on, "Hey, Dad, can you ask him," or she said, "Hey, Dad, can you give me a bookmark?" And I burst into tears. After all this time, she had no idea my name is still Chris. Anyway, dad joke, had to throw it in for you. You can use that on somebody else. Say it better than I did, please, as well. Work on the delivery. That wasn't all that good. But with that, what I'd like to do is to bring it to Ken's Corner. Ken, what do you have for us?
Yeah, absolutely. Got a couple ideas for everyone today. Again, June statements came out. If you get them electronically delivered, you probably already received them. You probably already looked at them. It was a tough month in the market. So hang in there on that one. And Peter Lynch, one of the most iconic investors back in the 80s and 90s, basically said this. And I thought it was really a really catching little one-liner, is that the way to make money in stocks is not to get scared out of them. And that was a really interesting sentence he made, because a lot of us feel that right now. So if we're 20 years away from retirement, we think that, oh, we have time on our side, and here we, this is gonna be fine right now because we can invest low. But if you have 20 days until retirement, you feel differently about it right now. So we're here for you for that. A retirement portfolio looks different than an accumulator portfolio. So just have that in mind. We think about these things all the time, and we're prepared for income if you're heading into retirement. We're prepared for that. We're prepared for the growth side if you're in the accumulator side of it as well. So we understand these two pieces. Just wanted to bring that to your attention when you do get your June statements, if you get them in the mail or electronically. So just keep that in mind. Stay the course, stay in them. And this too shall pass, as they say. So an idea here is, some clients are bringing this to our attention just to kind of kick around. And again, every situation is different. This is why we have to evaluate it on a case-by-case situation. Some are saying, okay, if we're accelerating our mortgage payments, and we have say a 3% rate right now, and say our monthly mortgage is say $1,000 per month, but we're doing $2,000 to accelerate it, this might be a time to back off the acceleration part a little bit. So a 3% debt is not that's good debt to have, but a good time to buy and use that extra to maybe buy lower in the market. That's one idea, but a case-by-case situation based on your scenario. Also, we're hearing from clients if there's extra emergency funds that are available, or if there's fixed annuities that are paying 1% or 1.5 that we've had for 10 or 15 years, because that was our scenario as we were building our wealth up. And now we look a little different. We may not need that's so much safety or so much cash because we're in a different spot today. A good time to take a look at that and maybe consolidate and take a look at, are there opportunities to be buying low in these markets that we're seeing right now with some money that was earmarked for something totally different 15 or 20 years ago. So maybe that was an individual scenario versus looking at a family wealth scenario. That could also be very, very, very beneficial to your family as well. So, there's a lot of retirement chatter around a lot of different companies right now, lump sum pensions, when to take it. You factor in vacation time if you're thinking about retirement. I was just at a friend's house the other night, and they work at a local company here, and they're talking about, the chatter is when to retire. You factor in vacation time, you factor in health insurance, you factor in Social Security, all these pieces of the puzzle we can help you with and put that together and support you as well. So we're here for you, big or small, big questions, big, small questions. Don't feel afraid to ask any of them. We love them. We're here for you. And with that being said, I'll pass it back over to Chris.
Awesome. Thank you, Ken. Let me do a one thing I was looking at. We've had some recent commentary too, and maybe you saw the 60-40 portfolio isn't dead. That's from Nick Murray. So you got to be very careful of these. Adjustments have been made. So in other words, once you have a massive, I think, remember 2 times ago, I meant this is one of the worst bond markets since 1848, some have said, which is very interesting. But when you look at that, that's because rates went up so quickly, and it was a surprise to many, but also that adjusted a lot of bond funds. One of my friends was talking at about a major firm, and their intermediate bond fund is down 18.4%. Now think about that. It's in all the 401ks, all their portfolios, it's down 18.4%. Having diversification across even fixed incomes makes it different. Remember, if you have low correlation investments, if you have some floating rate fund bonds, these all have mitigated a good portion of some of those downturns. And it doesn't always mean that they will, but by having that diversification, I think 3 of the bigger returns have been from alternatives over the last 3 years. Maybe looking even 1 year at convertible bonds, 1 year at global real estate, even the last year being let's call it real assets, or for us, low correlation investments. It's interesting to watch. Those are very important pieces, but I wanted to just bring that up as well because it's a really interesting perspective, if you will. And I think the Fed, a lot of people argue with the Fed chairman. When you come to inflation, 2 things happen. 1, inflation happens when there's too much demand and too little supply. That's prices going up, right? That's essentially inflation. Inflation is the cost of living going up at a whatever rate that it is, or deflation, which would be going down. Now, what's interesting is that a lot of times people change their actual behavior when prices go up. Things get too expensive, they'll stop driving. Things get too cheap, they'll start buying more as well. People get a lot of money, they spend it. People who don't have much money, they won't spend it, right? So there's that. But also when you get the Fed and the federal government both also trying to attack inflation, we might get three completely different people pushing down on a lever of inflation, having no idea what the outcome could be. So it could be massively positive, it could be kind of mucky, if you will, but everybody's trying to do something about it when truly, historically, markets typically do the best at moderating inflation. Well, super expensive, we're not going to do that as much now. So interesting to watch. There's some curves as well that becomes monopolistic inflation, but that's different. There's a lot of historical precedent to this, but it's interesting how quickly it's called. I think this is one of the articles. It's called Volcker, Powell, and the Price of Amnesia about monetary policy. It was in the Wall Street Journal, I think, a few weeks ago, a few weeks ago, if you will. But interesting to watch as you see some of those as well. Well, before I go into more droning on about fun financial facts and articles we may not have read or may never read, why don't I pass it over to Mike's Minute?
Thanks,
Mike,
Chris.
what do we have going on in the world of incredible research, all the different things going on we need to know?
Oh man. All right. Well, here we go. So I will continue to draw on draw out the financial talk and the mutual funds and stuff like that. But first I want to touch on something that Zach kind of said. So we always talk about bull and bear markets, and an internal argument that we've had here between Ryan and Zach and myself has been, what exactly does that even mean? What is a bear market? What is a bull market? And truly, it's the interpretations up for debate, as we continue to do here. It's more of a feeling, I would say, that when you're actually in a bear market, but you got to be able to measure that to be able to bring the statistics that Zach brings up. So a bear market it starts when from the all-time high, once that goes down below 20% from the all-time high, the bear market has begun from the all-time high date. So essentially, because we went underneath 20% on May 20th this year, the bear market technically began on January 3rd at that all-time high. So when we say 21 months is the average amount of time for a bear market, and now that's taking in some pretty extreme bear markets over the course of history, which brings that average even up a little bit. We've already been in this for 7 months. So here we are 7 months in. And to expand further on that, the idea of buying low and the potential return that you could get from that, we got a great chart from one of our partners that kind of goes in and quantifies this information. So now this is the 15th technical bear market. So we hit that 20% drop. 15th time the market has dropped 20% from the all-time high since World War II. Now in the previous 14, if you would have bought on the day that it hit 20% down, you would have on average 1 year later returned 17.5%. So that's the idea of buying low. Now 6 years later, the average return from that 20% down date is a total return of 79% is the average, without a single individual year still being negative from that date that you bought in. So for long-term investors, this truly is a great opportunity. We get questions from clients, should we continue to contribute? And the answer is yes. This is one of the best times to contribute historically. And so we're always going to come back with that answer. So thank you, Chris.
Thank you, Michael. That's awesome. That's awesome. So one of the things we have as well in some of this historical perspective, and one of the people we follow, many, Jeremy Siegel, Nick Murray, Howard Marks is one, and he put out a 13-page paper recently on this, and it's kind of interesting. It starts with some very good things. He goes, when I refer to a bear market, a real bull market, I'm not talking about the standard definition from Investopedia, which is a time and a period when the prices of an asset or security rise continuously, or a situation in which stock prices rise by 20%, usually after a 20% drop. Now he says the same thing. He's also not talking about a bear market being one of these bland drops where it's 19.9% or 20.1. He says the first is too bland. And I think this is a good point. When you look at it, it's how it feels. How does a market feel? And when you get to 19.1 or 19.9 or 20.1, there's no magic between it. It's really, as I look at it, it's the psychology, it's the behavior, it's everything behind it. It's how people really feel. And people talk right now as if we are in a massively long bear market. And that's interesting. So the fear is there. And I appreciate some of the statistics you guys are bringing up too, because it just backs it up. But more importantly, what do we do about it? That's the go forward basis. As we've said, stick through to it. Our plan is built for these kind of times. Sometimes what our clients have done in the past in history, in the bear markets back in 2000, also in 2009, is that they've adjusted their style of living. So some feel more comfortable adjusting their spending. Many of you have done it during the pandemic because you couldn't travel. So some people are staying on that. You'll find a lot of different things that you can do. But make sure you're just spending on what you actually enjoy, what actually is important to you. And sometimes tightening up, like I had a bunch of clients get rid of cable because the bill was $120 or $30 a month and they were watching, more things on YouTube TV instead. So some different ideas come up during this as well, which is, looking at your budget, what's truly important to making sure you're spending money on it if it was to continue. We have a lot of plans, a lot of things that we can do as it would continue. But also the chances are we have no idea when it ends or when it pops back up and starts to resume a bull market. But historically, inevitably, 100% of the time, bear markets have, quote, ended in an upturn. So that is a fairly high. There's also a bunch of other fun things as we go along here. But before I get to that, what I'd like to do is pass it over to Ryan to give us the important things to focus on. What are the happenings at Gentian, Ryan? What should we be focusing on?
What is happening at Gentian? A lot is happening at Gentian right now. I've got a big long list to go down, so have your pen and paper ready here. Later on this morning, 10:30, we have our next Health and Wealth webinar focusing on mental health today with Michelle Norris and guest speaker Marina Randles. So I'm personally really looking forward to that one. I always like to expand my knowledge on health and wealth, and mental health is definitely a big emerging area right now coming out of the pandemic and everything that's been going on crazy with the world the last few years. This weekend, July 7th through the 10th, of course, is our gathering on the green at Rotary Park. If you have already RSVP'd, I hope you have. It closed yesterday, but tickets have been emailed to all those who RSVP'd. And an important note about that, there are no parking passes for the Thursday or Sunday events. So you're not missing a part of your email if you're coming to Thursday or Sunday. There's no parking pass coming. And another note on gathering on the green, the opening time for our tent, if you're arriving on Thursday, we'll be ready to receive you at 4:30. On Friday and Saturday, we'll be ready at 5:30. And on Sunday morning, our tent will be open at 10:30 in the morning. Following that, July 13th, we have our next professional development day. So we will have some limited availability in terms of answering phone and email throughout that day. We will check periodically, but just know that we might not be able to get to you immediately, but we'll get to those throughout the day. July 15th, make sure to wish our own Lisa Sheridan a happy birthday. She will be, that July 15th birthday, which we will then celebrate later in the month with the July Birthday Club as well. July 20th is our next bi-weekly update, and that is also the date of our first annual Shred event combined with our second annual Eat Outside Day. So join us to shred some of those old documents you no longer need and enjoy some good food outside. Hopefully the weather cooperates for us for that one as well. We do have RSVPs that you can RSVP through the bulletin email. That is open until July 11th to RSVP for the July 20th. And then July 27th is the July Birthday Club event where you can join us in celebrating Lisa and every other birthday in July. Please RSVP for that by July 18th. That is also through the bulletin email that you would have received yesterday, the most recent one. And we also have our Ladies and Gentian event that same day, July 27th, the Storytellers event. So another nice event for the ladies of Gentian to come together and celebrate together. Back to you, Chris.
Awesome. Thank you very much, Ryan. Well, with all the music coming up, I know a couple of things. I've got a couple of questions for you. Do you know what rock group has 4 men that don't sing? Mount Rushmore. So I enjoyed that one quite a bit. So a dad joke for music is kind of fun. There's actually a couple more too, which you can use. What is the favorite kind of music that mummies listen to? Classical. No, I'm joking. It's rap music. I just wanted to mess with you a little bit, that one as well. This one is good for little kids, so you might want to use it. What did DJ Allergies say to the nose? Drop it like it's snot. Anyway, for little kids, they'll get it. They think it's funny. I appreciate those as well. Whenever you can give one of those to the kids. I know I've jumped off those a little bit, but you can record those. You can go back and see those, and those are kind of fun, if you will. Well, hopping back onto the topic too of the bull markets, it's kind of interesting. If you looked at them, bull markets, which ended with a bear. When you look at a bull market, and you can kind of back and reflect on this, there's 3 stages. First, when a few forward-looking people decide that the market's actually going to go up. I'm kind of giving you an idea of maybe what's to come, what to be looking for. The second is when most investors realize improvement is actually underway. And I'm not sure if we actually hit that in 2021 or not. But then the third is when everyone concludes that things will get better forever. Those are the 3 stages of a bull market. And obviously the stage to watch for is the third. The bear market is exactly the opposite. When a few people realize that things may not be as good as they seem. The second is when everybody starts to realize and talk about, oh, how bad it is. And then the third stage is when nothing's ever going to get better forever. So watch out. We're seeing some of that despondentness in the third. I'd like to simplify it into those 3. There's more technical aspects to it, but there's some perspective in those as well. I want to offer is that, as things get better here, most people aren't going to be ready for it when it does, but the things we're doing and helping you with here will conversions. Looking at tax minimization. There's a lot of different things we can do this year, which we couldn't last year. So what I would like to do today is close with just some thank you to you, some enjoy the summer, giving you guys an opportunity, if you will. Feel free to ask us any questions. We appreciate the questions you bring to us because it's what we use on the content here is things we answer. One thing I did have a question on, somebody asked me, say, what percentage of people are down in cryptocurrencies since they've been investing just over the last year or so? It was interesting. So I went through, and the very first thing when I looked up this, just asking the question, and it was interesting because the statistics started out that something like 20% of people in cryptocurrencies were down. This was in January. Then went to March or April, says 45% of people in cryptocurrencies are down. And just recently, I think it was as of May or June, there was an article that said 85% of people who invested in cryptocurrencies are down. So it's interesting to watch as you've seen that. This happens also in many other hot asset classes when people tend to get in at the end or the peak. That's just the nature of it. The reason it goes up is because everybody's getting in. The reason it drops because everybody's selling. But a lot of people get in right towards the peak because that's the nature of a peak. So interesting to watch that with cryptocurrencies as markets. It's cryptocurrencies has been said by many, even Howard Marks, to be pure human speculation, producing very little to nothing other than frustration. I thought it was an interesting statement, but it's interesting to see. Maybe it has its own guide, but the US dollar is a currency, Swiss franc is a currency, but you've not heard as much about cryptocurrencies lately, but a client asked me about that one as well. So I thought that was an interesting piece. With that, I'd like to, I know I've run a couple minutes over here, so it's 9:34. Many of you guys probably have already signed off. I'm just kidding. But we want to thank you tremendously from our team here at Gentian, from everything that you do for us, all the trust and faith you put in us, getting through these tough times, continue to offer you perspective, and also with your patience of getting through this. Remember, faith, patience, and discipline are what get us through bear markets like this. So we thank you. We'll continue to put pieces out. We don't put them out to alarm you. We put them out to inform you and help you be a great investor and swim against the crowd of negativity out there. So with that, we here at Gentian Retirement really want to say, planning it, living it presently, and then eventually giving it what the assets that you have is what we do and here to help with. Our team wants to thank you tremendously for all your patience, perspective, and sharing with us. We look forward to seeing you in a couple of weeks here, maybe some of you at your appointments, some of you at the gathering on the green. To many of you who are in other states as well, we want to wish you a wonderful summer. And if you're in the South, stay cool. And if you're in the North, get out. Anyway, we'll talk to you guys soon. Thank you very much. Have a wonderful, wonderful next 2 weeks.